Welcome to this week's Market Talk. I'm Amber Lancaster, joined by Paul Mampilly and Ian Dyer. Each week, we look forward to sharing our viewpoints with you, our readers, and giving insight into what's on our radar. Today's outlook is for the week of May 6th, 2019. I'll begin by sharing with you what I'm watching, and then we'll hear from Ian and Paul. Today, I'll cover three topics. The first will be my take on the U.S. economic data and the earnings release front. The second will be my story of the week. And the third will be the latest performance numbers on the Disruptification Index. This past Friday's change in non-farm payrolls hit it out of the ballpark. Economists were expecting 190,000 jobs added, but it was trounced. There were 263,000 jobs added, and the sectors that saw the largest increase in jobs were the highly paid professional and business services positions, followed by construction. The consumer confidence number also ticked higher with a print of 129.3, beating the 126.8 survey forecast. And consumer confidence is an economic indicator that shows how optimistic consumers feel about the overall U.S. economy and their personal financial situation. So this tick higher means that the market decline we experienced at the end of last year and the government shutdown earlier this year only weighed negatively on consumers' mindsets temporarily. This jump in consumer confidence is a powerful rebound and will positively carry us through the second quarter. Now, to press this point further, check out this compelling chart from Bloomberg and the Conference Board. In this chart, you will see four colorful lines: gold, red, white, and blue. The lines that I'd like you to pay attention to are the gold and the red lines. The gold line represents the consumer confidence present situation, meaning how consumers feel about economic factors right now. And the red line shows current conditions minus expectations. Now, whenever the red line crosses far above the gold line for at least 3 to 4 months, it's a significant precursor to a recession. This chart shows that since 1995, the red line has crossed above the gold line twice. This is where you see the yellow arrows. Each time a recession followed. Now, the first time was March 2001 through November 2001, and the second time was December 2007 through June 2009. As of today, as you see in the green arrow, the red line is trending below the gold. So for now, this chart is indicating no imminent recession. Now, looking forward to this week's economic releases, it will be a fairly light week with most of the econ releases taking place over the latter half of the week. Here are the most significant releases for us to pay attention to. So as you can see in this graphic, MBA mortgage applications for the period ending May 3rd will post on Wednesday at 7 a.m. On Thursday at 8:30 a.m., we'll see the initial jobless claims numbers for the period ending May 4th. March's trade balance report and April's producer price index, PPI, final demand month-over-month print will be on that time on Thursday as well. And the final print for March's wholesale inventories will post at 10 a.m. And rounding out the week, the consumer price index month-over-month for April will be released on Friday at 8:30 a.m. Now, earnings season is starting to wind down. So check out this list of some of the top U.S. securities reporting earnings this week. Per Bloomberg, there will be a total of 148 releases. These companies include Hertz, AIG, the Walt Disney Company, and Cisco. Now, my story of the week focuses on the initial public offering, or IPO, of Uber Technologies. It's making its public debut, which is slated for this Friday, May 10th. The deal size is valued at about $8.5 billion, and its share price midpoint will be $47. Now, the company will trade under the ticker UBER, And Uber's IPO will be the largest global IPO in 5 years. The last one was Alibaba back in 2014, and it will be the largest IPO in the US since Facebook in 2012. Simply put, it will be huge. So Uber I want to make you aware of a potentially highly profitable venture that Uber is embarking on in India. It has to do with micromobility. The ride-hailing giant has partnered with Yulu, an electric scooter and bicycle sharing company in India. And Yulu's vision is to reduce traffic congestion by providing a scalable, affordable, efficient, and clean solution for the first mile, last mile, and short distance commutes. Now, Yulu offers electric scooters and bicycles with a maximum speed of about 15 miles per hour. And according to the Economic Times, with a population of more than 1.3 billion people, addressing the first and last mile mobility in India has the potential to be even bigger than ride hailing for Uber. So not only will all eyes be on Uber's upcoming IPO this week, but also on this new potentially highly lucrative micro-mobility venture in India. Now turning to our disruptification index, this chart shows it continues to outperform all the major indices year to date. As of Friday, May 3rd's close, the index is up 25% versus 13.6% on the Dow and 17.5% on the S&P 500. So that's it from me. Ian, what are you watching today?
Thank you, Amber. So just about those macro numbers, first I want to say a little bit about the productivity that came out last Thursday. And it was at 3.6% growth quarter over quarter. And this is really what fueled the GDP growth of 3.2% that came out the week before. So productivity, of course, is when you have more output per input that you have in any economy. And the fact that it grew at 3.6% compared to an estimate of about 2% is huge. And we don't see beats like that often. And it was actually the second highest growth that we've seen in 9 years. And one part of this report that really stuck out to me was in the manufacturing sector, which is, of course, very cyclical. When the economy does well, manufacturing does well. And when manufacturing starts to drop, people get worried about a recession. But in this report, it showed that manufacturing actually had twice as fast output or growth as it did growth of labor. So you had a certain amount of people added to the manufacturing sector, and compared to that growth, the growth of productivity in manufacturing grew at twice the speed, which is great because a lot of people say that this employment, now that we're at very low unemployment rates, is a sign that we're getting too many people working in the economy. And at some point, that's going to be too expensive to maintain, and it's not going to be productive anymore. But at this point, we are seeing in one of the most cyclical industries in manufacturing that it's still at a very healthy level and that we're still getting a ton of productivity from these workers. And with the jobs report of 263,000, as Amber said, construction was the second highest amount of jobs added. Another very cyclical industry that's very promising for the economy. There were 33,000 people added to that industry in April, and now there have been over 250,000 added over the past year, and manufacturing has actually seen an increase of 200,000 workers in the past year. So we're still seeing these industries that really drive the economy continue to grow and get hundreds of thousands of new workers in the past year that really have driven the economy quarter after quarter. And I just want to also say a little bit about earnings. So as Amber said, we're wrapping up this quarter, but of the 78% of the S&P 500 companies that have reported, 76% have beaten the analyst estimates of profits, and 60% of the companies have beaten analyst estimates for sales. So we were talking a little bit about earnings before earnings season really started, and we pointed out that the fear that really engulfed the market at the end of last year had caused analysts to really set the bar pretty low for 2019 because they feared that there would be a steep drop-off in earnings, that we would see early signs of a recession starting this year. But we're seeing continued strength and growth in companies' sales and profits. So still looking very good. And we've seen the market hit record highs as recent as last Friday. So the earnings season overall has been very good so far. And finally, I want to talk a little bit about IPOs, and just to give a view on that. So along with the negativity about earnings at the end of last year, there was a lot of anticipation for new companies coming into the market, like Uber, as Amber's mentioned, and we also had companies like Pinterest and Lyft have really big IPOs. But there was also some negativity in there, and people are still saying that the main reason that we're seeing so many IPOs is because the big venture capitalists behind them that put billions of dollars into these companies want out because they see a recession on the horizon and they see a very weak stock market. And while it is good of them to take profits, we really can't blame them for doing that because these companies have grown so much over the past couple of years. We don't believe that that's the case. Instead, you can see this as a sign that these companies see the market as somewhere where they're going to find demand for their stock. So something that we've talked about with disruptification is old versus new, and these companies are representing the new. And of course, there's going to be a lot of demand for their stock because they are basically the future and what people are going to be continuing to use for decades to come. So the one that I really want to focus on is Uber, like Amber did, but I want to focus on something that's really captured a lot of headlines about them recently, and that is that they said that they may never be profitable. And if you've checked investment websites over the past couple of weeks, there's a really good chance that you've seen some article that's pointing this out. However, it's really taken out of context. And what this really is one of the many risks that's outlined in this huge hundreds of pages long document that every company has to file before an IPO called an S1. And some other companies that have filed this S1 that have not been profitable when they went public, like Amazon and Google, have said the same thing, because when you're talking about the risks of your company, you got to cover all your bases and you have to be comprehensive just to let your investors know what could happen. But we don't see this as really an issue. And like I said, Amazon and Google have done this. Countless companies that aren't profitable when they're going public are doing this. And it's not really anything uncommon. And it's just something that was really blown out of proportion by the media. So just getting into some reasons why we believe that Uber is going to be profitable is because they are growing their sales at a huge pace and their expenses are becoming kind of dwarfed by those sales. So in 2016, their operating expenses were about 98% of their sales, which means that a lot of their income was going straight to things like R&D and paying their workers and just overall operating expenses. By 2018, that number dropped to 62%. So we're seeing that they are growing their revenue way faster than they're growing their expenses. We believe this is going to continue as they continue to expand, and it's going to lead to eroded profitability. And just to outline a few of the ways that they're growing, the first that I want to point out is the number of rides. Of course, ride sharing is the biggest part of their business. The number of rides that they have given has gone from 5 billion to 10 billion in the past year. So it's doubled. And so they had 5 billion new rides in the past year compared to the 5 billion that it took them 6.5 years to get to before that. So we're seeing exponential growth here. We've also seen them expand that ride sharing business from 400 to 700 cities in the past year. They're now in 63 countries. And if you add up the population of all those countries, that gives you their potential market. And that adds up to 4.1 billion people. And right now, there are only about 90 million active accounts on Uber. So that's just over 2% of what they could really capture in the overall market. And at this point, where they're still growing so fast, it's hard to see them not becoming profitable when they have about 4 billion people of an untapped market. And lastly, they have really started to grow their Uber Eats business. It's now one of the fastest food delivery businesses, or fastest growing food delivery businesses in the world. They've grown from 280 to 500 cities in that part of their business, and they've also added over 100,000 restaurants to their selection. So they're really starting to capture a lot of market share in both of these segments. And with 4 billion people still untapped, there's a ton of room for Uber to grow. So they're valued right now at about $80 to $90 billion. But if you said $80 billion is way too much for them, it might be very short term. But if you see Uber's stock really start to drop a lot after it goes public, it would be a great time to buy in as a long-term investment. When you talk about $80 billion, that's not even in the top 100 publicly traded U.S. companies. So it's not really as big as it sounds, even though it's such a huge IPO. But overall, we believe that Uber has years and years of exponential growth ahead of it. They're really going to be a dominant force in their market. And ultimately, we believe that they will be profitable, and they will really start to build that valuation higher in the process. And that's all I have for this week. So, Paul.
Thanks, Ian. I have to say that, like, listening to, the negativity, whether it comes directed towards Uber or generally directed to our economy, to our markets, it's like blah, 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 blah. You just get tired of it after a while. And in truth, we have been going through this for 20 years. For 20 years now, someone has always been ready to tell you why something can go wrong. Someone has always been ready to tell you why the market can crash. Someone's always been ready to tell you why something is never going to work. And I'm personally just completely fed up when really all you have to do is look at the evidence. I personally myself invested in Google at the IPO. And I have to say I was foolish enough to listen to some of these naysayers. And so I sold out of my Google a long time ago. Obviously, that was pretty stupid of me. In truth, I didn't have that much money at the time, and so I needed the money. And I made a good amount of money. However, even if I simply just kept a few shares of it, it would have been great. And I can tell you all the same objections that people have to Uber, to Lyft, to all of these new companies. They were all sad back then, and the media was the focus of all this bad information. They generally sent you the wrong way almost all the time by focusing on the wrong piece of information and just generally being incredibly negative. So I'm just going to continue from where Amber and Ian were going and tell you that IPOs, I believe, are going to be massive. In 2019, 2020, they are going to be unbelievable. And the reason is because of what I just started out with, which is that we are coming out of like this slumber of 20 years where this country has sort of really gone into deep sleep, into huge, just everybody just wanting to hide underneath like your desk or something, being afraid of everything. And we now have these incredible new companies that represent the new world that's being built out. These are global companies. They represent new ways of doing things. And yes, of course, they are still growing. And because of that, they are for now unprofitable. Some of these criticism, whether they be leveled at Uber or somebody else, is crazy. Uber is growing at such a huge rate, they would be stupid to focus on profitability, because it would say, hey, stop investing in your business that's growing at 100% and try and capture a profit. No, they are taking every dollar they can and putting it into their business, and then they need more money because their opportunity set is so huge. So some of this stuff is just insane. I would tell you to dismiss these folks and just ignore them. It's crazy. And listen to us instead. Make sure you and your friends are all subscribed to Bold Profits Daily so that you can get a different view of the world, of the markets, and of the way things are going. So as you know, we at Bold Profits have been discussing creating a phenomenal service that really gives you insight into all these new companies that have been stockpiled in the private world that are ready to come public. And we've seen them come public recently. We had Pinterest come public, and we had this amazing Beyond Meat company, which synthesizes meat. Instead of growing it on a farm and then having to kill an animal, it's just made the same way we make lots of other things. We synthesize it, and that the IPO for Beyond Meat was up 163% in a day. So we think there is a massive, incredible opportunity here for regular investors to buy into these companies. Now, you can, you might say, well, Paul, I don't know. And I'll tell you that, of course, there are the superstar companies that are out there. Uber is obviously one, and Airbnb for sure will come. However, if you haven't been paying attention, I'm just going to run out some IPOs that have come and listen to these gains that have come. In the last, in 2 weeks, TradeWeb, which is, does, for markets and the bond market, what sort of Amazon and Uber did to their markets, their stock was up 56% in 2 weeks. 56% in 2 weeks. What about PagerDuty? This is a software company that sits, it's sort of underneath the internet layer at which we all go in at. This stock was up 95% in 3 weeks. Just think about that. 95%, just like that. Boom. And then Zoom Media, and this is the company that we use to record this particular update, up 120% also in 3 weeks. And last one, Jumia Technologies, which is the Amazon of Africa, up 85% in 3 weeks. So the reason I'm bringing these up is that there is a layer of sort of less known companies that are coming public where there is so much demand for these stocks because of the slumber that we've been in for 20 years, where people have been bearish, negative, pessimistic. You think of every negative thing, that's what they've been. And now there's a hunger for these new companies. And we think it's going to last for a while. It might last 3, maybe even 5 years. Because at the peak in the year 2000, which is now 19 years ago, we had about over 9,000 publicly traded companies in this country. Today, we have less than 5,000. Where'd those companies go? Well, many of them went bankrupt. Some of them were bought up. Some companies simply went out of existence. And so there is a ready market for a lot of these companies, and people are, I believe, are going to buy and be supportive of these stocks. So Amber, for example, wrote about a company last week in Bold Profits Daily. And again, make sure you're subscribed because we're doing unbelievable work here. We're really giving you incredible information. And she mentioned a company called Chewy, which is a pet company. And it's an unbelievable pet company. They're going to come public. Now, we have no idea for sure, if it'll be a good IPO, because IPOs are complicated, which is why we are creating the service, which is that you have to know how to trade them. You have to know how to analyze them. And you have to figure out, should you hold it? Should you sell it? So this is exactly the kind of complexity that a good service can really add huge value. So look out for emails from my publisher on the service. I believe this is going to be a phenomenal service and you won't want to miss out. So quickly, Ian and Amber talked about productivity and jobs. And if you've been watching us, you know that we've been on board with this. I've been telling you that productivity is about to go up for about 6 months now. I saw the first signs of it about 6 months ago, and you can go back on the YouTube channel and see where I mentioned this. And Ian's exactly right, which is that we are finally now in an economy where if you add, whether it be capital or you add a person to your company, they now add so much more value that it's worth adding a second person. And that's what productivity is. In other words, you get more than what you're paying for in terms of what you're putting in. So of course that makes a business owner want to invest more. So that's obviously a really good thing for our economy, for our markets. And I saw a headline today that really confirms what Ian was saying. What is going on, in a way, is very different from the last 20 years. What we have going on, even though it's through technology, it's through investments of the new, is that we have what's called a blue-collar boom. The businesses that are booming really are in construction and in making things. I've said this before in previous updates. We are going back to a country that makes things, whereas before, for the last 20 years, we sort of shipped all of that work to other places. So it might have been China, it might have been other places, but using technology, using Internet of Things, the many megatrends that we tell you about, we are now back to making things. And you can see what that's doing to employment, to productivity, and our economy. And that's awesome. So the stock market in response, I know it's selling off today because of tweets from President Trump, et cetera. However, the stock market is hitting new highs. And while there's always going to be up and downs, we think that the stock market is going to continue to go higher. And I want to mention one other country that has just begun a bull market, and that country is India. And most people are focused on China, focused on other places like Europe. However, India is a huge, huge market. It's a democracy. They got over 1 billion people. It's a free market. They have a stock market where there's a lot of cheap companies and where that consumer is similar to the American consumer. I'm unbelievably bullish about India, which is why this week, and here comes, I have to admit it, it's a shameless plug for one of our services. We are releasing incredible stock. This is a phenomenal company that really is going to roll out many of our megatrends around the world. They're a consulting company that pushes people out to implement Internet of Things, artificial intelligence all over the world. And it's an unbelievable stock, and we're going to release it this Wednesday, so you don't want to miss out. And that's going to be in our $10 million portfolio. We're sending out emails, giving you a chance to subscribe, so don't miss it and check out for those emails. A quick rundown of some popular companies and then some things that what happened at the Berkshire Hathaway meeting, which is Warren Buffett's company. People pay a lot of attention to what Warren Buffett says, and so I just want to cover some of that. One of the things that Warren Buffett said that I'm going to take the opposite side on, which is that Warren Buffett really questioned whether or not Tesla would be able to sell insurance, because this is one of the things that Tesla has said that they want to get into. And according to Warren Buffett, he thinks that Tesla's likely to fail. And in general, Warren Buffett has been very skeptical of Tesla. He thinks Elon Musk's a smart guy, he thinks Tesla is a poor company. And I'm going to disagree with Warren Buffett. I actually think that Elon Musk is right, which is that in today's world, having critical primary data is more important than the old way of how insurance companies actually calculate risk. And they do that by looking at incidences, historical incidences. But Tesla has real-time data on how a driver is actually driving. They can see actual incidents in terms of associating what actually happened to why an accident happens. And that's what's informing their autopilot, their self-driving program. And they're just looking at saying, well, what other place can we use this data? And they're like, hey, wow, well, we can actually tell less risky drivers from more risky drivers because they have primary data. And Warren Buffett's companies, and he's got, I think 70% of Berkshire Hathaway's insurance companies, Tesla represents a clear and present danger to all of their auto insurance companies and to other auto insurance companies. So I'm going to do the contrarian thing, and I'm going to say, I think that while, in the short term, Tesla stock may go up and down, long term, whether it be Tesla or somebody else, I think that Warren Buffett's car insurance empire is probably at risk. And so if I were him, I'd be worried, or he's dismissing it. Also want to quickly mention a couple of other things that came up during the Berkshire meeting, which is that Warren Buffett was very famously skeptical of all technology companies, particularly in 1999, 2000. And for a long time, he was right, which is that if you bought at the peak of the internet boom in 1999, 2000, you had to sit through a long period where you were down. However, I've actually gone back and done this, which is that today, the value of a company, for example, like Amazon, has gone up so much that even if you bought at the peak, at the very highest price of the internet bubble of 1999, 2000, you are beating the S&P 500, you are beating Berkshire Hathaway, you're beating everything. So no wonder that finally Warren Buffett, I heard, is his company anyway, is buying stock in Amazon, which is really something. So in other words, about 20 years after, Warren Buffett is sort of joining the technology revolution. So that's what some of the observations from Berkshire. Apple reported their earnings last week. And as you know, I'm famously been negative on Apple because their business looks to be in decline. And that's what they reported. They had a 17% decline in revenue. iPhone share unit volume is down. And the reason why I believe Apple continues to be able to keep its share price is that they're buying back a lot of stock. $75 billion they're going to add back in stock, also raising the dividend. So they're spending a lot of time supporting their stock instead of using their money really to innovate and support their business. Last thing, crypto roundup. You know that I believe that cryptos and cryptocurrencies represent the future of money, the future of finance, because it's faster, it's better, it's cheaper, more convenient. And Bitcoin last week hit $5,800. You know that I told you that in 2017, Bitcoin was a bubble and there was a bubble in cryptocurrencies. I also told you when I believed Bitcoin bottomed and you should buy in, that was about at 3,600 or so, something like that in that range. And now Bitcoin is at $5,800. And the reason for it is that there is, of course, all this political turmoil in Venezuela. And there's also some problem that's brewing around the finances of Brazil. And in the past, when you saw that, you would have seen people reach for gold. That's what they would go buy, or they would buy the US dollar. Today, however, cryptocurrencies represent a real alternative. And so you're seeing largely no impact on gold. However, Bitcoin and some of the other cryptocurrencies are going up. And so this is a place where I'm very optimistic what I believe is going to unfold. And so at some point in time, it would be something that we would look to explore. Maybe we'd start our own crypto service. However, that's something that I have some news for you maybe at some point in time. So back to you, Amber.
Wow. Thank you, Paul. Thank you, Ian. Excellent, excellent insights today. Awesome. And thank you to our subscribers and listeners for tuning in today. And just a reminder, if you like what you hear and what you see on this channel, Paul Mampilly's YouTube channel, please subscribe to us. Please comment, share the videos, and so we can just share the knowledge for everyone. So thank you again for tuning in. And until next week, everyone have a wonderful week. Take care.